All right, let's talk about the FOMC meeting that is going to be happening tomorrow. Okay, for people who are unaware, the FOMC meeting is called the Federal Open Market Committee, if I'm not mistaken. Basically, just the Federal Reserve coming together to have a meeting that lasts about 2 days for them to actually talk about the whole entire market condition, economical standpoint. What are they supposed to be doing with the whole entire economy? Where do they think that the different states and different part of the countries need more resources of, and then they actually kind of make like a game plan to see how to actually go about to help the whole entire country economically. But of course, they have a dual mandate, and it is for them to actually get low inflation, about 2%, according to the Federal Reserve, the long-term inflation rate at about 2%, and of course, to get maximum unemployment. Okay, so clearly in the past 3 years, they're not doing fantastically well. Okay, and this next meeting that's going to be coming up is going to be on the 31st of October, which will last for about 2 days. It will end on the 1st of November. So, of course, today I'm going to be filming this for you guys. So I'm not sure when you guys are going to be watching this. Chances are, because this is going to be an expectation video. Okay, so I do want to upload it on the 1st of November, and you guys will probably watch this. But I would be on my merry way in South Korea, because I will be traveling alone for about 10 days. So hopefully I can actually come back with another video for you guys. If I'm able to do so, that would be great. But of course, until then, I do want to leave you guys with this expectation video, because I think that it's pretty important for us to talk about this. So let's get down to this. Okay, so according to the last FOMC meeting that we actually had, or according to the last FOMC minutes that we actually had, it was quite obvious that we are most likely going to be getting another 25 basis point increment. Okay, so if you're going to be getting yet another 25 basis point increment, chances are, I'm not sure, a lot of people are expecting this, myself included, this to be the last rate hike. Okay, and of course, historically speaking, if this is the last rate hike, we are going to be expecting about 15 to 18 months before we see the first rate cut. So of course, if you're talking about this possibility of a 25 basis point increment this time round, which would mean that the interest rate right now is from 5.25 to 5.5, it's going to be raised 25 basis point upwards. It's going to be 5.5 to 5.75. So easier to say it's about 5.75% for interest rates. Okay, so for us to actually see a 5.75% interest rate, chances are economy is not going to like it. So I do want to talk about the risk in the market in general right now. Okay, because I had this conversation with a friend of mine where we actually are mutually interested in economics, we're interested in investments, and we just started to talk about this earlier today. Okay, and we talked about how are we supposed to actually invest in this kind of hectic market, because the current market at the moment, stocks market, is not going to be looking nice. Personally, I think the stock market is going to sideways trend for quite a bit, and chances are it might even sideways trend downwards. Okay, and of course I'm going to be explaining the indicators that I do see. Lagging indicators, it might be, but just things that I am currently worried about at the moment. Okay, so first of all, with interest rate going up at this, absurdly high level at 5.75%, possibly, okay, it means that bonds market is the one that is actually doing a lot of the work, be it bringing economy down or helping some people who are in the bond market make more money. But of course, with the bond market going up to this high level, if you are worried, you can just park your money in the bonds right now. If I'm not mistaken, 10-year treasury can easily yield you 5%, no problem. If you're looking at 2 years, 2-year treasury yield, you get quite a bit of money as well. So honestly, if you're looking for more guarantee with less risk, bonds at the moment is a really good place. But of course, do your own due diligence, because you really need to go and look up at the bonds prices. Don't pull a Silicon Valley where you get into bonds and then suddenly bonds just go up by like 700% and then you just get destroyed. Okay, of course, just do your own due diligence and see if you're able to actually wait out the whole period. Be it it's a 1 year bond, be it it's a 2 year bond, a 10 year bond, whatever it is. Okay, if you're able to hold out the whole entire duration of the bond, then you are golden. Okay, so just do as it is what you want with this information for the bonds side. So let's talk about stocks. Okay, I don't think that the stocks market is going to be going very well, simply because currently the entire stocks market, we do not have any good tailwind. Okay, good news is bad news is worse news. I think this is going all the way back to 2021 all over again. We have seen this happen, and we just kept on going downwards for the whole entire year, just for 2022 to like be even worse. And then in 2023 we start to see a little bit of a pickup, and then immediately afterwards we got met up with a lot of headwinds. So let's talk about the elephant in the room, which is inflation. Okay, the Federal Reserve obviously thinks that inflation is going down. Well, clearly, I guess, according to data, you can say that inflation is going down, but prices are not going down. Okay, prices have stopped increasing, or at least increasing at a much slower rate, but has not come down. Okay, inflation coming down and prices coming down are two separate issues. Okay, just because an item that goes up in, well, not an item, let's just say a commodity, let's just say eggs. Okay, let's say you go to the market, you want to buy eggs. Okay, if eggs continue to go up in price every single year, that's inflation. However, the thing is that, yeah, it's true, it was going up at 10% every single year, and this year is only going up by like 5%. Inflation did drop, but the prices of eggs is not dropping. It's still going up year after year, just by the multiplication of the inflationary pressure. So the thing is that when inflation is not going away, the Federal Reserve is trying their best to actually fight for this argument that, inflation is actually slowly going away. So I think that this economy is strong. And, unemployment is getting better because there's a lot more jobs in the market at the moment. Well, a lot more filled jobs in the market at the moment. But of course, you can easily justify this from the other point of view, because people are starting to take up multiple jobs. Okay, people who have day jobs, they are taking up an additional job as an Uber driver, doing DoorDash, or they can just be going to Walmart to get an extra shift. So a lot of people are starting to get multiple jobs because the price or the cost of living is constantly going up. And when the cost of living continues to go up, why? Inflation. It's always back to the big I word, inflation. And that's going to continuously happen until we can actually get to the bottom of this. And of course, let's just take all the commodities and put them aside, and let's talk about asset prices. Okay, because when we talk about asset prices, we're going to be talking about your houses, we're going to talk about your cars, we're going to talk about jewelry, watches, assets that basically go up in price, appreciate over time. And all these different assets, let's just say, real estate, for example. I've always talked about this on my channel by a large extent as well, which is housing prices is consistently a lagging indicator when it comes to inflationary pressure. You're not going to see housing prices change in the next, month by month. You're going to see it change maybe every 12 months or every 18 months and things like that. Okay, you're not going to see a sudden shift immediately because it's a lagging indicator. Okay, be it the prices of houses or the rental prices of houses, it doesn't matter, because all of this are being signed by a yearly basis or 2-year basis or whatever it is. So you're not going to see it as a inflationary or deflationary pressure by the month. You're going to see it after a pretty long time. So of course, what I'm actually saying is these two different scenarios at the moment. Okay, we either going to see us going into a recession without solving the inflation situation, which is a very, very possible situation. Or let's just say the Federal Reserve somehow managed to actually stop this whole entire thing together. Interest rate actually goes up to, let's just say, 6%, and we're able to curb inflation properly, and inflation is now kept there for 12, 13 months. And then the Federal Reserve says, you know what, let's start the cut rate now. And when Federal Reserve start the cut rate, asset price goes up because asset price did not actually go down in the one whole year. People are basically just holding, they just don't have to sell their houses. If you don't sell your houses, chances are your houses are not going to be going down in price. People would still need to continuously buy houses, and people are not selling houses, which means that there's still going to be a flat inflation rate of about 2 to 3%, for example. For the sake of this comparison, let's just say US houses goes up at about 2 to 3% a year. Of course, that's very, very generous, because houses in US actually goes up like, 10% a year. But let's just say it just go up by 2% a year. It did not go down in price. And what's going to happen is, when we finally get the first rate cut, that's going to make people, encourage these people to start buying houses, because mortgage rates are going to be cheaper. You can refinance immediately. There's so many different options for you to start getting your houses, and you actually see a clear path for it to become cheaper. What would that actually create? More inflation on assets. And when you get more inflation on assets, now you're back to the same bubble again, which is inflation causing the recession again. So right now, which is why I don't see myself putting in money into stocks market as much. Right now, I do have most of my money in the stocks market, and I'm making this video right now preemptively for you guys, because I am really, really deciding to stay out the stocks market for a period of time. And it could easily be in this week. So I could sell everything and just stay out of the stocks market. I'm not sure. There is a very, very high possibility of what I'm able to, what I would probably be doing. Which is why I kind of want to relay this out and kind of put it into video format for you guys, so that you guys kind of understand where I'm coming from. And of course, at the same time, I do also want to talk about the earnings season that we just had as well, because all the earnings that actually came out just prove stocks are even worse than it was before, because stocks are just simply not outperforming any other financial instrument on the market at the moment. If you are really that worried, if you're really someone who's interested in investment, you probably want to pull out of stocks and go into bonds. Okay, not only because bonds is so little risk, close to no risk, but at the same time, it's also because bonds at the same time is giving you 5 upwards to 6% on your annual growth. It's actually ridiculous, okay? Like, we are not even talking about dividend stocks anymore, because they don't even make sense, because you're taking on the risk of capital gains on whatever stocks that you are going to be buying into, be it your AT&T, Apple, whoever who's giving you all these different dividend stocks, dividend payment. All these different stocks are going to be going through stocks risk, okay, which is you're holding on to the actual market risk itself, okay. Of course, you're able to, because of the market risk, you can get a higher or lower percentage of your dividend yield. But if you're going to bonds, you're going to be getting relatively high yield without the risk. It's almost like a no-brainer move of sorts, which is why I do think that it's going to be interesting to see how bonds actually play out in the next, I would say, about next 6 to 8 months. It'll be really, really interesting, especially right before we start to see a rates cut in the market. Bonds is going to be super duper crazy. So yeah, I thought that it was quite interesting for us to actually go through all that. And of course, I did record a video about the earnings season, so just keep a lookout on that. I think I'll probably be uploading it right after this. So if you're going to be watching this on Wednesday, it's probably going to be out on Saturday. But again, because I'm going to Korea, I will be traveling in South Korea. That means I might be filming, I might not, I'm not sure. But if you do want to keep up with whatever I'm going to be doing, just check me out down below. My Instagram link is down below. Follow me there. I basically would post daily, be it when I'm at home or when I'm traveling. But when I'm traveling, I'm definitely going to be posting a lot more. Especially I'm going to be traveling alone this time. So I thought that's going to be quite interesting. But yeah, anyway, I would try my best to actually come up with another video talking about the FOMC meeting that happened, because I'll be bringing my iPad along. So there would probably be a day where I would just kind of want to go through the reports myself and actually just explain it to you guys on what is happening as well. But hey, that's all I have for this video. Thank you so much for watching, and I'll see you guys in the next one. Peace out. Bye.